Welcome to a deep dive into the world of day trading strategies, specifically designed to help you make money in volatile markets. In the financial world, volatility is a term that's bandied around quite a bit. It refers to the degree of variation in the trading prices of securities over a certain period. Essentially, it's a measure of the rate at which the price of an asset increases or decreases for a set of returns. Markets are considered volatile when there are significant price swings and shifts in a short span of time. Now you might be thinking, volatile markets? That sounds risky. And you're not wrong. Volatility does indeed bring with it a certain level of risk. However, it also brings opportunities. Yes, you heard that right. Opportunities. You see, day trading in volatile markets is not for the faint-hearted. It requires quick decisions, a solid understanding of market trends, and an unwavering commitment to a well-defined strategy. But the rewards can be substantial. The key is to understand these volatile markets and to have a robust strategy in place to navigate them. Now, the importance of a solid strategy cannot be overstated. In a volatile market, things can change in the blink of an eye. One minute you're riding high on a rising stock, the next, you're scrambling to mitigate losses as that same stock plummets. A well-thought-out strategy not only helps you identify profitable trading opportunities, it also provides a safety net, a plan of action, when things don't go as expected. Over the next half an hour or so, we're going to explore some of these strategies. We're going to delve into the nuts and bolts of scalping, swing trading, trading the news, and reversal trading. We'll also discuss the crucial aspect of risk management in volatile markets. Understanding volatile markets and the right strategies to navigate them can be the difference between success and failure in day trading. So, let's dive in and unravel the mysteries of day trading in volatile markets. Are you ready? Let's get started. Before we delve into the strategies, it's crucial to understand what volatility is and how it affects the markets. So, what is volatility? In the simplest terms, volatility refers to the degree of variation in the trading prices of a security, an index, or a market over a specific period. In essence, it's a measure of the speed and magnitude at which prices change. The larger the price swings, the higher the volatility. Now, how do we measure volatility? There are several ways, but one common method is the use of the Volatility Index, or VIX. The VIX measures the market's expectation of future volatility based on the prices of options on the S&P 500 index. When the VIX is high, it indicates that traders anticipate significant price swings, and vice versa. But here's the kicker. Volatility is not a directional indicator. It does not tell us whether prices will go up or down, only that they will move. This is where the concept of implied volatility comes in. Implied volatility, often used in options trading, is a measure of expected future volatility, and it can give us a sense of the market's mood. High implied volatility may suggest that the market is expecting a major move, but again, it doesn't tell us in which direction. So, what does volatility mean for day traders? Well, it's a double-edged sword. On one hand, high volatility can present opportunities. After all, day trading is all about buying low and selling high, or vice versa. The larger the price swings, the greater the potential for profit. On the other hand, high volatility also means greater risk. Prices can move against you just as quickly as they can move in your favor, and the consequences can be severe if you're not prepared. To manage this risk, day traders need to be disciplined and vigilant. They need to stay informed about market trends and news, and they need to have a solid understanding of technical analysis and risk management. They also need to be able to keep their emotions in check. Fear and greed can be powerful motivators, but they can also lead to poor decision-making. Finally, it's important to remember that volatility is not constant. It can change rapidly in response to news events, economic data, and other factors. This means that day traders need to be adaptable. They need to be able to adjust their strategies and approaches based on changing market conditions. Armed with an understanding of volatility, we can now explore the strategies that can turn it into an advantage. The first strategy we will explore is scalping, a popular approach among day traders. Scalping is like a game of speed chess. It's all about making numerous trades throughout the day, each one aiming to catch small price movements. While the gains from each trade may be minimal, the accumulation of these small profits can lead to significant returns at the end of the day. The name scalping comes from the idea of skimming off a small profit from the market, much like skimming the foam off a freshly brewed cappuccino. So how does scalping work? Picture a bustling marketplace. A scalper is like a trader who buys a basket of apples and sells them one by one, making a small profit on each apple. In the world of day trading, scalpers buy shares, currencies, or other financial instruments and sell them after the price has moved slightly in their favor. In an ideal scalping scenario, this process is repeated hundreds of times throughout the day. Scalping is particularly effective in volatile markets. Why, you ask? Well, volatile markets are characterized by frequent price movements, and these movements are the lifeblood of the scalping strategy. When prices are constantly fluctuating, there's ample opportunity for scalpers to profit from these small price changes. In a calm market, these opportunities simply don't present themselves as frequently. Let's illustrate this with an example. Imagine you're trading a particular stock. You notice that this stock's price tends to fluctuate by about 20 cents every few minutes. As a scalper, you could buy 100 shares of this stock and then sell them as soon as the price goes up by 5 cents. Repeat this process 40 times throughout the day, and you've made a tidy profit without the stock price needing to make a significant move in any particular direction. Of course, while scalping can be profitable, it's not without its challenges. Scalping requires a trader to be highly alert and responsive. Much like a hawk, a scalper needs to be ready to swoop in at just the right moment to capture their prey, or in this case, their profit. It's a strategy that demands quick decisions, close monitoring of the markets, and precision in executing trades. Moreover, successful scalping requires a solid understanding of the market and the ability to analyze charts and indicators quickly. It's also crucial to have a good risk management strategy in place, as even small losses can add up quickly when you're making a high volume of trades. In terms of tools, scalpers often rely on real-time charts and technical indicators to identify trading opportunities. These might include tools to track price trends, volume, and other market data. Some scalpers also use automated trading systems to execute trades quickly and efficiently. It's worth noting that scalping is not for everyone. It's a high-energy, high-intensity strategy that may not suit those who prefer a slower, more methodical approach to trading. But for those who thrive in a fast-paced environment and who have the discipline and focus to stay on top of multiple trades, scalping can be an exciting and profitable strategy. Scalping requires quick decisions and precision, but it can be highly profitable in volatile markets. So if you're a day trader seeking a strategy to leverage the opportunities presented by market volatility, scalping might just be the strategy for you. Next, we delve into swing trading, another powerful tool for day traders. Now, swing trading is a unique strategy that primarily operates on the principle of capturing one single move or swing in the market. Unlike scalping, which involves making numerous trades for small profits, swing trading is about fewer trades, but with the potential for larger gains. So, how does swing trading work? Well, in essence, a swing trader aims to profit from price changes or swings. These traders are not concerned with the intrinsic value of stocks, but rather their price trends and patterns. Swing traders typically hold onto a trade for a period ranging from overnight to a few weeks, as opposed to just minutes or hours like scalpers. This strategy is especially effective in volatile markets. Why, you ask? Well, volatile markets are characterized by large price swings and fluctuations, and it is these price swings that swing traders aim to capture. In a volatile market, these price swings are more pronounced, therefore potentially offering greater returns for our swing traders. Now, let's bring this concept to life with an example. Consider a stock that is in a clear upward trend. Our swing trader observes this trend and decides to buy. Over the next few days, the stock price continues to climb, and our trader decides to sell after a significant price increase. This single trade, held over a few days, has netted a considerable profit. This is the essence of swing trading, capitalizing on price swings within a trend. But remember, swing trading isn't just about buying and holding. Swing traders are active, constantly monitoring their positions and market trends. They use technical analysis tools like trend lines and moving averages to identify potential trading opportunities and decide when to enter and exit trades. One of the distinct advantages of swing trading is its flexibility. Unlike day trading, where traders need to be glued to their screens, swing traders can spend less time monitoring their trades. This makes swing trading a more feasible option for those who can't dedicate their entire day to trading. However, it's important to note that swing trading also comes with its own set of risks. Since trades are held for longer periods, they're exposed to overnight and weekend market risks. Unforeseen events can cause markets to gap against the position, leading to significant losses. Hence, it's crucial for swing traders to employ risk management strategies, like setting stop-loss orders, to protect their capital. In conclusion, swing trading is a dynamic trading strategy that seeks to capture significant price swings. It's a method that trades fewer times but aims for larger profits. It's especially potent in volatile markets where price fluctuations are more pronounced. And while it does require a keen eye for market trends and a good understanding of technical analysis, it offers a balance between the frenetic pace of day trading and the long-term commitment of buy and hold investing. So, if you're a trader who is comfortable with holding positions for more than a day and can handle the associated risks, swing trading could be a strategy worth exploring. After all, the aim of the game is to maximize profits and minimize losses. And in the world of trading, having a diverse arsenal of strategies can be a significant advantage. Swing trading can capture larger price moves and can be particularly effective when markets are volatile. So, are you ready to swing into action? Our third strategy, trading the news, leverages real-time information to make profitable trades. This strategy is all about speed, accuracy, and the ability to predict how the market will react to various news events. Now, let's delve into the nitty-gritty of news trading. This strategy is based on the premise that news events can cause a significant impact on the financial markets. When significant news breaks, it can create big swings in market prices. News traders try to capitalize on these market movements. They aim to predict how the market will react to news events, buy or sell securities accordingly, and then make a profit when the market moves in their favor. So, if a company announces better than expected earnings, a news trader might buy shares in that company, expecting the price to rise. The beauty of news trading lies in its potential for high returns. Because news can cause such significant market movements, it can present opportunities for big profits. But, as with any trading strategy, it's not without its risks. News can be unpredictable, and market reactions can be equally unpredictable. Another challenge with news trading is the speed at which things happen. News can break at any time, and market reactions can be swift and sudden. This means you need to be on top of your game, ready to act at a moment's notice. Timing is also crucial in news trading. The most significant price movements often happen shortly after the news breaks. If you're too early, you might buy or sell based on rumors or speculation, which can be risky. So how can you succeed at news trading? Well, it starts with having the right tools and resources. You'll need a reliable source of real-time news, a trading platform that allows for quick trades, and a solid understanding of the financial markets. In conclusion, news trading is all about speed, accuracy, and prediction. It's about using real-time information to make quick decisions and capitalize on market movements. It's a strategy that can be highly profitable, but it's also one that requires skill, discipline, and a good dose of caution. Trading the news can be risky, but with the right approach, it can be a game changer in a volatile market. Last but not least, we'll discuss reversal trading, a strategy that thrives on changes in market direction. Reversal trading, as the name suggests, is a trading strategy that involves identifying points in the market where a price trend is likely to change direction. It's a bit like standing on a beach watching the tide come in and trying to predict the exact moment when the waves will start to recede. Except in this case, we're not watching the ocean, we're watching the ebb and flow of market prices. So, how can we spot potential reversals? Well, there are several indicators that traders use to predict a possible reversal. One of the most common is the Relative Strength Index, or RSI, which measures the speed and change of price movements. When the RSI reaches a level above 70, it indicates that a security might be overbought and due for a price pullback. Similarly, when it drops below 30, it suggests the security may be oversold and ready for a price bounce. Another popular tool is the Moving Average Convergence Divergence, or MACD. This indicator shows the relationship between two moving averages of a security's price. When the MACD line crosses above the signal line, it's a bullish signal that suggests it might be time to buy. Conversely, when the MACD line crosses below the signal line, it's a bearish signal that might indicate it's time to sell. Now, you may be wondering why reversal trading can be particularly profitable in volatile markets. The answer lies in the nature of volatility itself. In a volatile market, prices swing high and low, creating a multitude of potential reversal points. Traders who can accurately predict these points stand to make a tidy profit. For example, imagine a hypothetical stock that is in a steady uptrend, consistently hitting higher highs and higher lows. Suddenly, the stock's price begins to falter, failing to reach a new high and instead starting to trend downwards. A reversal trader, spotting this shift, could sell the stock short, profiting from the subsequent downward trend. But remember, reversal trading is not for the faint of heart. It requires a keen eye, a cool head, and an ironclad discipline. It's a strategy that demands both patience and the ability to act decisively when the moment is right. Reversal traders must resist the temptation to jump the gun and instead wait for a clear sign that a trend is about to reverse. This might mean watching a stock's price fall for a while before deciding to buy, or watching it rise before deciding to sell. And even when the signs are clear, there's always a risk that the market will not behave as expected. However, with careful planning and a disciplined approach, reversal trading can be a highly effective strategy. It can help traders to capitalize on the dramatic swings in price that characterize volatile markets, turning uncertainty into opportunity. So, to sum up, reversal trading is all about studying the market, identifying potential turning points, and acting decisively to take advantage of them. It's a strategy that requires patience, discipline, and a good understanding of market indicators. But for those who can master it, reversal trading offers a way to profit from the very volatility that others might shy away from. Reversal trading requires patience and discipline, but can deliver significant profits in volatile markets. No matter the strategy, risk management is critical in day trading, especially in volatile markets. In the world of day trading, risk management is like your invisible shield. It's your line of defense against the unpredictable swings of the market. And in volatile markets, it's not just a nice to have, it's an absolute must. Let's start with a fundamental truth. Every trade carries risk. It's an inherent part of the game, but that doesn't mean you can't manage it. And in volatile markets, managing your risk is not just about protecting your capital, it's also about seizing opportunities when they arise. So how do you do that? Well, there are several ways, and we'll go over a few key ones. Firstly, setting stop losses. Think of a stop loss as your safety net. It's a predetermined level at which you'll close a trade if the market moves against you. Setting a stop loss allows you to cap your losses, ensuring you live to trade another day. But remember, in volatile markets, prices can swing wildly and stop losses can be triggered more frequently. So it's essential to adjust your stop loss levels to account for increased volatility. Next, let's talk about determining position size. Position size refers to the number of shares or contracts you take on a trade. The size of your position can significantly impact your risk level. A larger position means higher potential profit, but it also means higher potential loss. So how do you decide the size of your position? It comes down to how much risk you're willing to take on and how confident you are in your trade. In volatile markets, it can be wise to reduce your position size to mitigate risk. Then there's the trap of overtrading. Overtrading happens when you make more trades than necessary, often driven by emotion rather than strategy. It's like being in a candy store and trying to eat everything in sight. Sure, it might be fun at first, but eventually, you'll get a stomachache. Overtrading can lead to quick losses, especially in volatile markets where prices can change rapidly. To avoid overtrading, stick to your trading plan and don't let fear or greed drive your decisions. Finally, remember to diversify. Don't put all your eggs in one basket. By spreading your investments across different markets or sectors, you can reduce your risk. If one trade goes south, others may perform well and offset the loss. Diversification can be particularly beneficial in volatile markets, where one sector may be hit hard while others thrive. So, there you have it. These are just a few of the ways you can manage your risk when day trading in volatile markets. Remember, the goal is not to eliminate risk entirely, that's impossible. Instead, the goal is to manage your risk in a way that allows you to capitalize on opportunities while protecting your capital. And here's one last tip. Always keep learning. The markets are constantly changing, and the best traders are those who adapt with them. So, continue to educate yourself and refine your strategies. Your future self will thank you. Effective risk management can be the difference between a profitable day trader and a losing one, especially in volatile markets. In conclusion, volatile markets can present unique opportunities for day traders. They may seem intimidating, but as we have seen, with the right strategies, we can navigate these choppy waters and turn them into advantageous scenarios. Let's take a moment to recap what we've learned today. Firstly, we explored the fast-paced world of scalping. This strategy is all about making numerous trades throughout the day, capitalizing on small price movements. It's like catching fish with a net. Each catch might be small, but together they can add up to a substantial haul. Remember, speed and precision are crucial in scalping. You need to be quick on your feet, and even quicker with your decisions. Next, we dove into the realm of swing trading, a strategy that aims to catch the swing within a trend. It's like surfing. You're trying to catch the wave at just the right moment to ride it to its peak. Swing trading requires patience and a keen eye for market trends. It's not about the number of trades you make, but rather the quality of those trades. Our third strategy was trading the news, a strategy that leverages the impact of significant news events on market prices. It's like being a hawk, soaring high in the sky, waiting for the right moment to swoop down on its prey. This strategy requires a thorough understanding of the market and the ability to predict how news will impact it. It's a high-stakes game of prediction and timing, but the potential rewards can be substantial. Lastly, we discussed reversal trading. This strategy is about identifying the point where the market is about to change direction and then jumping in just at the right time. It's like being a tightrope walker, carefully balancing on the line, ready to take the leap when the moment is right. Reversal trading requires a deep understanding of market trends and the ability to read subtle signs of change. It's not for the faint-hearted, but for those who master it, the rewards can be considerable. Of course, it's important to remember that all these strategies come with their own sets of risks. That's why we also discussed the importance of risk management in volatile markets. It's like having a life jacket when you're out at sea. It won't stop the waves, but it will help you stay afloat. Effective risk management involves setting stop losses, diversifying your portfolio, and never risking more than you can afford to lose. Remember, each of these strategies has its own strengths and weaknesses. Some may be better suited to certain market conditions than others. It's not about finding the best strategy, but rather the one that works best for you. It's about understanding the market, knowing your own strengths and weaknesses, and adapting your approach accordingly. In the end, volatile markets can be a day trader's best friend. They provide the ups and downs, the ebbs and flows that can lead to significant profit opportunities. But they also require a high level of skill, strategy, and risk management. It's a challenging environment, but for those who are up to the task, the rewards can be well worth the effort. With the right strategies and effective risk management, you can turn volatility into a profitable opportunity. So take what you've learned today, apply it to your trading strategy, and see where these volatile market waves can take you. Happy trading.